With all the recent bank failures and concerns about FDIC insurance, it leads us to wonder, what would happen if a big brokerage firm like Schwab went bankrupt? Would their clients' money be safe, or would it be at risk? We're going to focus here on Schwab since they're the custodian for my firm. And if you weren't aware, Schwab purchased TD Ameritrade back in 2019, and everything will become officially Schwab later this year after Labor Day. However, all of this would apply to other big brokerage firms like Fidelity or Vanguard. So where does this discussion land in our hierarchy of financial needs? This is one of those basic details that come together to build a solid financial foundation. And the example we're talking about today, simply understanding how brokerage firms and banks work, can keep us from making some of those behavioral mistakes that could cost us along the way. One crucial distinction between a brokerage firm like Schwab and a bank is the way that each accounts for its deposits. Banks accept deposits from customers which are recognized as liabilities on the bank's balance sheet. These deposits are considered demand deposits, meaning customers can withdraw their funds on demand or access them through checks, debit cards, and other means. As you know, banks are insured by the FDIC, which provides deposit insurance coverage of up to $250,000 per depositor per insured bank. I went into more detail on FDIC coverage in our video last week. I'll post a link in the show notes below. In contrast, brokerage firms like Schwab primarily hold customer deposits as assets, not liabilities, on their balance sheets. Any funds held by customers in a brokerage account are classified as customer assets rather than Schwab's liabilities. However, brokerage firms may offer cash sweep options such as money market funds. Some of these do not have the same regulatory protections as bank deposits, while others, ironically, are FDIC insured since they may be offered through an FDIC insured bank, such as Schwab Bank, so creatively named, which is all kind of confusing. So, money market funds at a brokerage firm can be either FDIC insured or insured through SIPC, which I'll cover momentarily. So what about your investments at Schwab? Like all other brokerage firms, Schwab acts as a custodian for various investment products, including mutual funds and exchange-traded funds, or ETFs. However, it's important to note that these funds and ETFs, they have their own separate custodians. This separation ensures that the assets of the funds are held independently, and it mitigates the risk of commingling the assets that Schwab has, and it enhances investor protection. For instance, if you wanted to purchase DFAU, Dimensional's U.S. Core Equity ETF, your funds would eventually wind up at that ETF's custodian, Citibank. The custodian, Citibank in this case, keeps a separate account for Dimensional's ETF funds that are separate from Citibank's assets on their balance sheet. So you can see the layers of protection with third-party custodians here. Okay, so Dimensional is great and we love them, but what happens if you've purchased one of Schwab's funds or ETFs? Let's say that instead of DFAU, you want to purchase SCHB, Schwab's US Broad Market ETF. Well, in this case, the custodian for SCHB is State Street, not Schwab. So Schwab isn't even the custodian for its own funds, and that's not a bad thing. When the fund manager and the custodian are one and the same, that's when shenanigans can start to happen, as Bernie Madoff showed all of us. In the unlikely event of Schwab's bankruptcy, the mutual funds and ETFs held by investors would remain separate from the firm's assets and would not be subject to the claims of any of Schwab's creditors. The custodians responsible for safeguarding these investment vehicles would continue to hold them on behalf of the investors. This separation protects the interests of mutual fund and ETF investors from the potential fallout of the brokerage firm's financial troubles if they ever had them. Okay, so if you have your investments at Schwab or any other big brokerage firm, you could feel safe that if they went bankrupt, your investments would still be safe. However, there's no telling if your investments' values wouldn't go down. If a huge custodian like Schwab went bankrupt, there's probably some bad things going on in the economy. Where banks benefit from having FDIC insurance coverage, brokerage firms have a different form of protection for their customers. The Securities Investor Protection Corporation, or SIPC, is a nonprofit organization established by Congress and is funded by its member firms to protect customers of any failed brokerage firms. SIPC provides limited coverage to investors in the case of a brokerage firm's insolvency. SIPC insurance protects against the loss of cash and securities held by customers up to $500,000 per customer, including a maximum of $250,000 for cash claims. However, it's crucial to understand that SIPC protection does not guarantee the value of investments or safeguard against market fluctuations. It is primarily designed to cover instances of fraud or theft or bankruptcy within a brokerage firm. However, Schwab and other large brokerage firms also carry excess SIPC insurance protection. In Schwab's case, it would protect against an aggregate claim amount of up to $600 million. So there's even more coverage available beyond what SIPC typically insures. In contrast, FDIC insurance covers bank deposits up to $250,000 per depositor per insured bank. It guarantees the return of principal and accrued interest on qualifying deposits, regardless of the bank's financial condition. While all these recent bank failures are concerning, understanding the difference between how brokerage firms and banks are structured can give us some peace of mind. Unlike banks, brokerage firms primarily hold their clients' money as separate assets rather than liabilities on their balance sheets. These assets would not be subject to the claims of any creditor in the unlikely event that Schwab or any other brokerage firm went bankrupt. While anything is possible, losing your money should your brokerage firm go bankrupt is a low probability event simply based on how these firms are set up. However, if you're still worried if you should stay at your small bank, then check out this video to learn more. I'll see you there.